Now, I value the interaction in class, so if you have questions, you have problems understanding materials, raise your hand anytime, okay? And then when I give questions, think about it. If you can answer it, raise your questions, participate with me in class. Okay, so first we'll go over 3 topics, and if we have time, we'll continue after this. So we'll first distinguish what is managerial accounting and how is it different from financial, which we already briefly talked about it. And then we identify what is the current business trends in nowadays business world. How is it different from 2 or 3 decades ago? Ethical standards, just so you have an understanding of what is expected for managerial accountants who's working in the firm, what is expected from them, how should they take care of situations when there's dilemmas. Okay. And then today we might briefly cover a little bit of what is the cost that factors in service company, what is the cost that we will be looking at from the merchandising companies, and also what is the cost that factors in manufacturing companies. So recall in financial accounting, if you still remember, the first 4 chapters, the general guidelines of GAAP, General Accepted Accounting Principles. We introduced to you service type of business, which in the book uses an e-learning company as an example. So the first 4 chapters in financial accounting, we covered service type of business. Their income statement is a lot simpler than Chapter 5 and 6, merchandising companies' multi-step income statement, right? So financial accounting, you already got introduced to what is service type of business income statement, what is merchandising's business income statement. In this chapter, managerial accounting, we will also introduce to you what is manufacturing companies' income statement look like. What does it look like? How is it different from the first 2 types of business companies? Okay, so the differences here, again, financial accounting, we're focusing on providing information to owners, another word, investors, whoever invests money in the business. They want to know how the business is operating, so they need financial statements to base their investing decisions. Creditors, so who are creditors? Lenders, people who borrow money to the business to help their capitalization, help them expand their business lines. So companies usually get money from either investors or creditors. So these 2 parties definitely need information from the business in order to base their decisions on whether they're continuing to invest in the business, continuing to lending money to this business, or they may want to terminate this decision, shift to another company. Okay, so these are the parties. Also, taxing authorities, regulators, they need to know whether the business is paying taxes. Others, customers, society, they also need to know how the company is doing. So what we learn in financial accounting, putting together summary information in statements, income statement, retained earnings, balance sheet, cash flows. These are statements for outside users, for people not working in the business. Okay, so these are some of the examples of the parties. What managerial accounting is focusing on is people inside the business, managers. So as management accountants, we're supporting managers in their decision making on planning, on controlling, on budgeting. Okay, so what we're learning in this course, we're not providing information for outside users, but for managers to help them base their decisions on whether, for example, to increase retail price of a certain product, whether to cut costs of certain products, to purchase other raw materials that are cheaper with the same quality, or perhaps expand different business lines in manufacturing and to other countries, foreign countries. Okay, so these summary reports we learn in this course, we're assisting managers to make decisions. And managers, the reason why this course is important is because managers is responsible to all the other parties. Managers is responsible to customers. When they sell products, they have to make sure customers are getting the product as promised, with the quality, And perhaps the time has to be in time. If they ordered it within 7 days, it has to reach to their hands, be delivered within 7 days. Creditors, managers has to make sure they have enough fund to pay creditors. They borrow money to them, they have to pay interest back to these creditors. They also have to make sure employees are working in a safe environment. So all these parties that demands some sort of information, some sort of quality, safety from managers makes this course important. Okay, we're learning how to provide information to assist managers in making decisions so they can be responsible to these parties. Okay, so again, financial accounting focuses on outside users. Managerial, we're providing information for managers to help them be responsible to these parties. Okay, in terms of planning, what does it mean? Planning means setting goals, making decisions, plan ahead of time what we're trying to do in season 1, season 2, season 3. So planning is simply making goals, and of course these goals at the end has to turn into numbers, turns into profits, right? So managers have to make decisions whether to increase business lines, to terminate certain business lines, to increase retail price for certain products, to cut the cost for some of the products. These are all some of the things they have in mind in terms of planning the business in the future. Budgeting, what they need to do here is after they plan, make some plans, decisions on different seasons, goals, how do they actually implement this? So where are they getting the resources from, and how much does that cost? How many employees are they hiring, and what is the salary they're paying off to employees? So budgeting is mathematical expression of the plan, of the goals that you make. Right? You're turning your goals into actual numbers and trying to see whether this is going to be profitable or not. This is what budgeting is all about. Planning ahead of time, expecting the profit, expecting the cost. Try to do analysis up front. After you plan the goals, after you turn it into numbers, what controlling is about is you implement the plan, and now at the end of the season you may need to do evaluations on these plans to see whether your plans matches with the budget you did earlier, and if it doesn't, how can you change it to make the second season better, to make the third season better. Okay, so all these decisions, the main decisions managers does falls under 3 categories: planning, setting goals, making goals up front for different seasons in this year, budgeting. Based on these goals, how do you turn it into numbers? Where are you getting your resources from? What are you paying to your employees? At the end, after you implement the plan, compare it against the budgeting, see if you're actually carrying it out as you planned, or what are the things you need to change later on. Okay, a more detailed table of a comparison between financial and managerial. So the first category, let's take a look at users. Again, financial, the users of these information is outsiders, investors, creditors, taxing authorities. Managerial, internal users, management levels. Purpose of the information. Financial helps investing, crediting decisions for investor creditors. Managerial, help managements plan, control, and do budget. Okay, third category, the focus and time dimension. Usually financial accounting statements, remember, we do it at year end. After a year of business operations, we summarize the reports into 4 statements. Managerial report could be more detailed and also could be requested upon management's request. So accountants, they provide information, could be a daily basis, weekly basis, or upon manager's request. So actually financial statements, since financial statements in financial accounting course you learned, it's strictly abided by GAAP, generally accepted accounting principles. As opposed to that, management's report, management accountants, that the reports they provided to managers doesn't necessarily have to follow strictly by GAAP. So, for example, if the managers request information only on a certain line of the business, you're only just providing the information of that line of the business instead of the whole set. So you're not providing a comprehensive set of information, but actually based on managers' request on certain areas, certain departments, certain activities. But of course, we still have to apply accrual accounting instead of cash-based accounting. So the base is the same. It's just that how you represent the information doesn't have to be formatted in a way the same as the 4 statements. It's not as strict as those. So these are the main differences. The upper categories is the most important thing you need to know. Users differences, the focuses, what's the purposes of these 2 categories in accounting. Rules, restrictions, scope of information. One is a very comprehensive report. One is detailed reports on certain business lines upon manager's request. Okay, questions so far? Okay, now let's do a short exercise here. So try to read through these A, B, C, D, E statements and see if you can determine whether it's referring to financial accounting or managerial accounting. And we'll go over these in 2 minutes. Anybody who came in late that didn't get a syllabus or that I missed? Pass it to the back. Okay, let's take a look at these statements. It says, helps investors make investment decisions. Financial accounting, because investors are not working inside a business, outside users. So the first one, financial accounting, is what it's referring to. Second, provides detailed reports on parts of the company. Managerial accounting. Okay, it's not a comprehensive report, a summary of all the business operations information. It's only detailed reports on certain parts of the business, of the company. You have the second one? Third one? Yep, go ahead. Managerial accounting helps in planning, controlling operations. Exactly. So these are the decisions that managers make, set the plans, make goals, carry out, do the numbers by budgeting, and then control the plan, make sure that the plan is going as it was said earlier, or if there's differences between the plan and the budgeting, you have to make some sort of adjustments. D, reports must follow generally accepted accounting principle. Financial, strictly follow GAAP because these information is provided to people who do not work in the business. They rely on these statements to base their decisions. So there has to be a unified standard and rules to control these statements that public companies offer to outsiders. Last one, reports audited annually by independent certified public accountants. Financial. Now this is something that I missed earlier. I didn't really talk about in detail, but only financial accounting reports, those 4 statements, are audited by accountants. Managerial reports provided to managements, they're not audited by CPA firms because it's only for the purpose of insiders, for them to do planning, to do budgeting. So the reason why CPA firms has to audit this is to make sure that those financial statements representing a comprehensive information of business is appropriately stated. Okay? But managerial reports, what we're learning in this class, for inside users, they know in a broader sense what's going on in the business operations, but they need the detailed numbers to make decisions for further seasons. Okay, questions on these 5 short problems? Good to move on? Okay, the second category, second section in this first chapter, we're going to go over some of the trends we see in nowadays business. So maybe before we go into this, can you tell me some of the trends that you see in nowadays business, but you don't see perhaps in you won't picture it in your grandpa or grandma's age? Some of the features of business. Technology, important. Information systems built in the business, right? You don't see this 30 years ago. Or if you do see it, it was a proposition, not actually carried out, right? What else? Online purchasing. So you can nowadays we do purchase things on Amazon, eBay, or other companies that has a website, right? We can do that anytime we wake up, we turn on our computer 24/7, we can purchase things. But this e-commerce concept doesn't exist 30 years ago. What else? What about nationwide? Is it easy to transfer business lines to foreign countries earlier? No, it's not. Transportation is a problem, cost is a problem, right? But nowadays, it's easy to fly to different countries, to purchase materials from different countries, and perhaps ship the whole operation to another country just because the workforce is cheaper there, right? Outsourcing, exactly, right? So we already mentioned some of these features here, right? Some of the features that you mentioned is actually listed here. We see that nowadays, we talked about global competitions a little bit, shifting some of the business operations to other companies because they have advantages over what your country offers, right? Perhaps you focus the workforce, shift the business operations, some of the business lines to foreign countries where they have cheaper salaries, cheaper employees, right? Or you purchase materials from other countries that it has cheaper cost, but it has the same quality. You may also partner with foreign countries, so combining these two companies together perhaps give you a competitive advantage over you being alone or the other company being alone. Now, being partner companies, you can stand stronger compared against your competitors in the certain market areas. We also talked a little bit about technology. So nowadays, information systems built in the business is very important for them to turn that off. Built-in information systems is very important for companies, for managers to control what's going on in the business, how resources has been inflowing, outflowing from the business. So a simple example, if you go to a grocery store, nowadays when you check out your items, go to the registers, they scan your products. Automatically, after they scan your products, the system inventory level for certain products will decrease, so the purchasing departments will know after a whole day or a whole week or a whole month, they know which products are selling more than others. They know which ones are low in inventory. They have to repurchase. They have to replenish more. Right? So this is a simple example of information systems linking to selling side. So purchasing departments will know when inventory is running low, and perhaps they also have an automatic way to link to purchasings, to link to actually doing the purchase orders automatically. E-commerce, we talked about purchasing things, selling things online. So that's a very convenient way to expand customer scope. So if originally you own a local business, perhaps the customers is just people in the county, in the city, and that's at most. But if you sell your things online, through e-commerce, you sell your things through the internet, you can reach to wider areas, different countries of customers. Right? So you have a broader scope of customers based on e-commerce. Now these two philosophies here, just-in-time management, total quality management, we'll be covering in more details in Chapter 18. Just a brief summary of what it is. Just-in-time management, some of the companies apply this philosophy in order to keep a lower level of inventory and just request materials, produce products as requested by customers. Okay, so the goal of applying this philosophy just in time is when customers request orders, request products, they ship in the materials just in time for production, they produce the products and ship it to customer just in time as they request. So for the companies that has JIT feature, that means they usually keep a low level of inventory in their warehouse instead of having huge quantities of inventory that takes up a lot of the space, a lot of cost. Okay, we'll go into this in more detail in Chapter 18. Total quality management, another philosophy applied in some of the businesses. Basically, the goal is to provide superior, the highest quality possible of products and services. So these businesses, if they have this philosophy running in their business, basically they want to have a program that continuously improve their product, continuously improve their services. So a lot of these, they have employees training, they do feedbacks, they do surveys with customers to know what are the strengths and weaknesses in each and every case of services they do with customers, the products they provide to customers. Once they get the feedback, they want to continuously improve their operations through the second season, through the third season. Okay, so the general idea of what total quality management is, they want to have the highest possible quality of products provided to customers, the highest possible quality of services provided to customers. That's the ideal case. By continuously improving their service, improving their products, but at the same time, also have to generate profit. So they have to balance between the two. Okay, so these are some of the features you will see in nowadays business, which is quite different from 2 or 3 decades ago. We have online systems, we have information resources planning systems, global competitions. We may have few business lines in other countries. We may also partnership with companies from other countries as well. Philosophies in order to keep a lower level inventory, to not have a huge quantities of inventory in the warehouse, takes up a lot of space and cost. Total quality management, we want quality services, quality products to customers. Okay, we'll be going over these in more details in later on chapters. This is just for you to have a general idea of what are the topics we'll be touching on. Okay, now again, short exercise time. It's just based on what we go over, the discussion we had earlier. These two descriptions, try to see if you can match it with A, B, C, D, which one it is. Right, who wants to try the first one? total quality management, how did you get that? Okay, so the keywords you probably got was superior products and services, right? The highest possible quality of products and services. This is a philosophy runs in the business to help them continuously improve their products, their services. So not just the quantity they sell to customer, but also the quality of the products. So the first one is total quality management, exactly. Second one, using the internet for such business functions as sales and customer service enable companies to reach 1,000 customers around the world. E-commerce, so you can purchase products, customers purchase products online 24/7, and companies, they sell it through online instead of just their local business stores. Now we have two more. Oops, sorry. The number 3. Okay, software system that integrate all companies' worldwide function, department, data into a single system. So it's an information system that captures detailed transactions that happens on a daily basis from all the department's activities in order for managers to see what's going on in different departments. So this is an information system we call an enterprise resource planning system. Okay? So what just-in-time is, and it's providing managers, enabling managers to keep a lower level of inventory to, upon customers' request, they order raw materials, produce it on time, ship it to customers. So the goal for just-in-time is a system that keeps a lower level of inventory in their warehouse. Okay? So they reduce the waste, reduce the cost in the inventory warehouse, but of course at the same time they have to have a strong relationship between these vendors, these suppliers of their raw materials. The quality of the raw materials has to be superior in order for them to order it immediately, start producing, provide it to customers. Okay, so JIT, again, JIT, Total Quality Management, we'll be going over in more details in Chapter 18. Here you just have to know a general idea what it is. Any questions? Yes. Mm-hmm. That would be, that example that I gave you was immediately, because I used the word immediately to know the actual where the resources flow, where the product has been sold. But just in time, the definition of this usually is on not the sales part. Sales part is just one part of it, not only the sales part, but actually the entire manufacturing side. So it's more on ordering materials as fast as possible, start producing the products, and then ship it out to customers. Right? So the example I gave you earlier was an example of immediately for managers to see the information of the transactions through inventory systems online. Right? But just-in-time here, a system which a company produces just-in-time to satisfy the needs, is basically focusing on the production side. Okay. Other questions? Okay, let's move on to the next section. Just a brief introduction of ethical standards that is expected for management accountants to abide by. Okay, so people who work for the company as an accountant, there are several ethical standards set in place by the Institute of Management Accountants in order to guide these accountants to make decisions with an ethical standpoint and not to make decisions or actions that will discredit the profession. So in the book, when you get the textbook, there's an exhibit that states a very detailed information on the ethical standards. You can read through them. It won't be really the course of this class, the core of this class, but really you have to know what's there. So what is expected for management accountants to follow. So basically whatever they do, it has to be within their professional areas. The decision they make has to be according to their professional competence. The ethical standards states that they have to continuously develop skills in their professional area. Other core concepts in the standards: confidentiality. Information that management accountants know cannot be disclosed to other parties, other companies, other competitors. It has to be kept in the business. So management accountants obviously have all the numbers with them. They know the costing side, production side of the numbers, they know budgeting, they even know the future plans in the business. These information has to be kept inside the business, confidentiality. Other core concepts in the standards mentioned was integrity, competence. Of course, whatever decisions management accountants make, they have to make sure they're not engaging in unethical situations that will discredit the profession. Okay, they have to make sure to mitigate conflicts of interest, and the information they provide to managers has to be timely information, credible information, also has to be the comprehensive information for them to make decision. You can withhold some disadvantaged information that happen in the manufacturing side and not let the managers know. Okay, so these are just the core concepts surrounding all the standards listed in the textbook. You can also read through the cases there. There's an example given to you on inflating inventory, which is obviously a wrong thing to do, meaning that if you have inventory shipped as FOB destination, do you still remember what FOB destination is? We have shipping point and destination. Seller pays it. So if my company is buying something and I agree on FOB shipping point, once the order is set, that's actually the inventory that belongs to us, even though we haven't received it, right? But what if it's FOB destination? If we set the order today, the inventory comes in 3 days later, and let's say it's the end of the year, can we record this as inventory? No. We can only record it next year, beginning January, once we actually receive it. So in the textbook, there is an example given to you on whether to inflate the inventory or not. The obvious answer is no, because if the agreement is FOB destination, once you receive it, that's the time point you record it as inventory. But if it's the end of the year, you can't inflate the inventory level just because you have the order, but you don't actually have the inventory yet. So that's an example. Others, if you have $100 worth of inventory ready to sell to customer, but you haven't actually sell it. Now it comes to year end again, you can't actually just change those inventory numbers into expense and then assume that it has already been sold to customer. Even though it might soon be sold to customer 2 days later, 3 days later, if you don't have the order set in place with customer, you can't just adjust the inventory asset into inventory expense, cost of goods sold, and then make sales entries. Okay, so those are the examples in the textbook. You can read through this section, give yourself a better understanding of what is expected from management accountants. Have to keep information to themselves, not disclose it. Have to do their duties based on their professional skills, and have to continuously improve the skills. And when they provide information to managers, it has to be the information, the comprehensive information. They can't withhold any information that they know that will severely affect managers' decision. They have to report the whole set of information. Okay, now the second half of this chapter, earlier what we talked about is what is managerial accounting, how is it different from financial, what is nowadays the business trend in nowadays business world. And we also mentioned briefly on ethical standards. Now the second half of the chapter, we're shifting toward costing side, which is really getting to the core of this entire course. Costs is very important to determine and very important to keep track of because you want to compare against sales, retail price. So what's the differences, what's called the differences between cost and retail price? Which is the most important thing in a business? Profit, right? And then, of course, it breaks down to detailed net income, operating income, and gross profit. It comes from that all the way. But the general idea, cost and sales revenue, the difference is profit. So this makes cost very important because, of course, company will want to reduce this part and increase retail price in order to gain wider profits. Right? So let's take a look at different type of business, how they determine unit cost for their services, for their products. So service type of company, we mentioned this in financial accounting as well, first 4 chapters. Remember an example, e-learning services company is an example that keeps on coming up in the chapters. Service company, they don't actually provide goods. They don't have inventory. They don't have manufacturing process going on. This is for manufacturing companies. Service company, they provide their skills, their knowledge. They may set the time to talk to you, do consulting services. They may be selling insurance to you. They may be perhaps selling you wireless services, Verizon's, AT&T. These are the companies that don't actually have inventoriable cost, but their cost really is only the expenses. The people they hire, the place they set the business, rental expense, insurance expense for the company, and all the equipments, office, machineries, or other things that's set in place in an administrative office. Those are only the costs for service company. They don't have inventory. They don't have products. Okay? So what you learn in financial accounting, first 4 chapters, you see a very simple income statement with upper part revenue, lower part all the expenses. That's the income statement for service company. You don't see cost of goods sold. You don't see all these good stuff we'll introduce later on. Okay, so for service type of business, this is what your income statement looks like. This is refreshing your memory. You've seen this before in the first 4 chapters in financial accounting. Upper part, service revenue. Latter part, all the costs incurred, expenses incurred in order to make that service revenue possible. Okay, so we have salary expense, the people you hire, rent expense, the place for the location for services provided, utilities comes together with the place, depreciation on furniture on the building, long-term assets, we depreciate it from time to time. Could be a monthly basis, could be a yearly basis. Interest expense, if you borrow money, you have to pay interest to third parties. Supplies expense, if you use up supplies, it turns into expense. From assets, turns into expense. So altogether, this is an example given to you on e-learning service company. Let's say they have, assuming they have 1,950 customers. Assuming. So if I tell you all these services, these revenues comes from 1,950 customers, then what would be the average cost per customer for these services? Okay, again, these $7,600 revenue comes from providing learning services to this many customers. And the cost incurred for providing these services is $3,900. So what would be the average cost per service, per customer? 1950. People. Oh, sorry. People. Okay, so these are the number of customers. This is the cost. What is the unit cost per service? $2? Around $2. How do you get that? Divided using, the cost would be 3,900, right? And you divide it by the total number of people. $2, right? So this is the unit cost per service. This seems easy because this is a service type of business. We don't have actual products. We're not thinking about materials yet. So we just take all the total of the expenses. This is the cost of doing business divided by total cases of services we provided. It could be customers, it could be each individual e-learning cases. Okay, now why are we looking at this? Units cost is important because we need to determine what we're going to charge these customers, right? So you've seen earlier service revenue. That's what we charge the customers. That's what we receive from them. So you need to know what is the average cost per case in order to determine and to mark up a price for retail price, for services revenue that you're receiving from them. Okay, and it has to be a number above $2, otherwise you're not gaining anything. Right? So you need to know what does it cost to do the business in order to see and to plan ahead what's the profit you're getting. So this is a first example for service company. Now another type of business also covered in financial accounting in chapter 5 and 6, those are related to inventory, right? So those businesses relates to, okay, before we go on to that, let's take a look at this exercise here. So see, this exercise continues on the service type of business. We have Dunkin' and Oats provides haircutting services in the local community, and they provide services to 230 clients. Here's a detailed breakdown of the expenses incurred in order to provide service to them. You have supplies expense, building rent, utility, depreciation. Now let's say the revenue for this period, $5,200. The total revenue for providing services to 230 clients. So what is the net operating income for the month? Try to figure this out. And what is the cost of one haircut providing to one customer? Okay, take a minute to do the calculations, and then we'll go over this after a minute. wants to try, how do we calculate operating income? And just tell me what is the process of getting to the number. Mm-hmm. $3,012. Slightly different. Very close, but the process how you got the number is correct. So operating income, we calculated by adding up all the expenses you see up there, subtracting it from revenues, $5,200. So that's the operating income altogether. If we want to trace this back to each and every haircut, each and every customer, divided by the total number of customers, 230. Okay, so what we're tracing here is not the profit. We're tracing the cost. Okay, so the first question here, asking you net income, we're comparing revenue against cost. Subtract cost from the revenues. We get $3,015. This is operating income. Second question is asking you what's the cost per haircut. So all the costs is the total expenses you add up, and you divide it by the total clients, 230. Just the expenses, because we want to know cost, right? Not what's the profit per case, okay? Okay, so make sure you pay attention to what the question is asking you. It can also ask you what's the profit you earn per case, and you'll be using 3,015 divided by 230. But if it's the cost per case, add up all the expenses, the cost of doing the business divided by total number of clients. We're trying to get to the unit cost per service you provide. Okay, questions? Yes. 950, you got the total expenses here, right? And this is revenue. So this question is asking you income, right? But here we're not asking you what's the profit per case, but what's the cost per case. Expense per person, exactly. Okay? What's the cost of doing business with each and every client, the average cost. Okay, so just like earlier what we did for 1,950 clients, the e-learning services, we divided from the e-learning services. Here we're adding up all the costs of doing the haircuts and trying to figure out the unit cost per customer. Okay, so this is service type of business. Doesn't have inventory in their business, so we're just adding up all the expenses, operating expenses. That will be the cost for doing their business for each and every client on average. We move on to manufacturing side of merchandising companies. So what merchandising companies means, refreshing your memory in financial accounting, chapter 5 and 6. Merchandising companies, they purchase products, it's already completed products, ready for sale, from wholesaler, from their vendor, and then they mark up the price, sell it to customers. Okay, so merchandising companies is purchasing products that are readily completed, that are ready for sale, purchased from wholesaler, and then they sell it to their customers. So an example would be grocery store, an example would be malls, places you go to that they don't actually manufacture those goods, they purchase it from other companies. This is manufacturing, merchandising types of company. So for merchandising companies, cost of goods sold is a major expense because that's how they earn profit. It's how they earn gross profit, how they earn operating income from. So what cost of goods sold, how we capture this, just to refresh our memory. If you have the beginning inventory level from last year, plus all the new purchases inventory that you made in this period, and of course new purchases comes with freight charges, that together is also part of inventory cost. minus ending inventory will give you this period's cost of goods sold. Okay, so this is not something new. This is actually refreshing your memory from financial accounting. An example for this, assuming last year, December 31st, we have, let's say, just $100 worth of inventory, beginning inventory. And then you make new purchases. You purchase orders from wholesalers, from vendors, $1,000 more. And these $1,000 worth of inventory comes with, let's say, $10 freight charges. Okay, so up to now, altogether in this period, the total inventory value available for sale to customer would be $1,110. With $100 beginning inventory carried on from last year, new purchases $1,000 that happened this season, comes with freight charges. Altogether, total available cost of goods for sale to customer is $1,110. So how do we get to the end? What are the actual items sold out to customer? We have to compare this available for sale against what's actually left at the end when it comes to December 31st. Right? That will determine what's the actual cost of goods actually sold out to customer in this season, in this time frame. So let's say the ending inventory, we only have $50 worth of inventory left. That means we made a lot of sales to customer because based on this, the differences, we'll get to the total cost of goods sold, $10,060. Okay, so what I want to get to here is you have to know how to get cost of goods sold, how to determine this number. If a problem gives you information on beginning inventory, new purchases, freight charges, ending inventory, you should be able to calculate this $10,060 cost of goods sold. And these costs, we compare it against retail price to determine the profit for this season. Okay? So this is introduced in financial accounting. If you forgot about this, that's okay. You have time to review it this week when you go back home. So just kind of read through chapter 16, what we covered so far, about half of the chapter. And I'll see you Friday, right? Any questions? Your book is only financial, right? It's not the comprehensive one that had.